Yes, guys. So I hope I'm audible to you. I haven't spoken anything. So I can see your comments right up in YouTube, guys. So I can keep replying. So, but I can only watch the comments only after a point of time where I'm done with a particular paragraph or explaining a particular paragraph on today's standard. So yes, guys. So we are going live from now on. So we will be doing continuous live sessions on YouTube or even on tuition.in. Tuition.in is giving enormous amount of support in making sure the classes are going uninterrupted to all the students. So our basic intention is to make sure that this time that we have, where I am also free, I'm absolutely free, and where students are also absolutely doing nothing at home and just preparing. So we can provide some additional support to the students for those who are writing either in this June probably, okay, because some of them are still confused whether the exams will be conducted in June. So let us be prepared that the tentative timetable which ICA has given. So let us assume that the timetable is perfectly fine because you have more than 8 weeks of time to go for your exams to come in. So let's assume that the 8 weeks of time is more than sufficient for you to complete preparation. And even for those people who are going to write in November or even the subsequent attempts in 2021, so these classes are basically going to provide you the sessions in an interactive manner. How is it interactive when you can't speak to me? Very well, you can comment on YouTube. I will definitely be reading each and every comment provided they make some sense. No good mornings, no highs and all. So please make sure that it is content related. Yes, we have informal conversations in between. Absolutely fine. We don't have a problem with that. Just but keep try to at least keep the things more objective, right? So today our session is predominantly based on Ind AS 116. It's a direct copy paste of IFRS 16. There's no additions or deletions from IFRS 16, guys. IFRS 15 was basically dealing with revenue recognition. So now we are dealing with IFRS 16. So this IFRS 16 or Ind AS 16 which has come in is basically replacing our earlier standard on Ind AS, that is Ind AS 17, or it was IAS 17. Grave necessity, man. As we progress by, as attempts keep passing by, new standards are keeping on, coping up or approaching us. Observe the last attempt in 2019, all those people who have written the exam, they were not having IFRS 16 or Ind AS 116 in their syllabus. But look at you guys who are writing in 2020 or 2021, IFRS 16 is already there and already in application, and right now is also necessary for you to be trained and for your exam purposes. Educational material on IFRS 16 and Ind AS 116 have been already released by ICA. So you need to understand that as attempts progress by, then the standards will keep on developing in its form. So one thing we have to be really grateful is we are trying to basically include more and more newer generation transactions into the scope of Ind AS or into the scope of IFRS now. Now, earlier reporting was a different format, and today's the reporting is a complete different format. Now, where have we seen new standards come up? I think 2009 we got 30, 31, 32, and immediately in 2012 it was withdrawn. 2015 came in with Ind AS with 41 standards, and out of which few of them were relaxed. And then from there on, if you keep on observing, your Ind AS 115 came in, 116 comes in, and now 117 is already in the state of taking some guidances upon. So if you look at, we are evolving in its form. Yes, one thing which every student will claim is, sir, as I keep progressing with the attempts, I think I'm trying to read more and more than what I was doing in the previous attempt. Now that is a common scenario, but one thing let me tell you, even if you were qualified at this point of time, you should be having sufficient knowledge on the latest updates. Be it on reporting, be it on GSTs, be it on income tax, one has to keep themselves updated. That is what every person looking at a chartered accountant normally expects. Now suddenly someone comes up to me and says that since you are a chartered accountant, tell me what is the tax planning. I tell them, no, I am not my tax partner. There's another tax partner of mine who can help you. Then the first question they'll ask, are you a CA or not? because according to them, CA basically does everything. Does GST, does income tax, does FEMA, does company law, everything he does. There's nothing that he does not do, which is not right. But at the same time, I think every chartered accountant, even though he is qualified, should be updated with the kind of knowledge that he has. Even though I am not into GST, I'll try to keep myself updated on what is happening around GST. I'll try to keep myself updated with the income tax law. That is because people do expect from us. And it is not always necessary that you have to keep on depending on your partner's word. So, this IFRS 16 basically, or Ind AS 116, I can say, is with effect from, comes in with effect from 1st April 2020 onwards. Actually, it is 2019, but I'm keeping it as 2020 because that is when we will be drafting our first set of financial statements. So I'll take it as 1st April 2020, or you can take it as 1st April 2019. This is the date on which this standard actually comes into application. Now, whenever we are talking about this standard coming into application, then what is it so different from what it had before under Ind AS 17? Ind AS 17 was also talking about leases, and even now your IFRS 16 or Ind AS 116 is also talking about leases. What is such significant differences that you will find out here? Now, the significant difference or the reason why Ind AS 116 was necessary at this point of time to be implemented or to be brought into picture is because of certain things which were missing in Ind AS 17. I'll say, sir, I thought it was a very comprehensive standard. And earlier when I heard about Ind AS 17, it looked quite comprehensive enough. What did it leave out of? It left out on a certain presentation requirements which were necessary under operating leases. Now, whenever I talk about this operating lease concept, I think most of you remember either your accounting standard 19, AS 19, which did talk about leases, or even if you remember Ind AS 17, both of them had a very similar accounting treatment for operating leases, where it says that every operating lease, a lessee has to recognize the amount paid under operating lease as an expense, and every lessor will recognize the amount paid under operating lease as an income. And whenever it was done over a period of time on a straight line basis, is what it says. That means there is no recognition of an asset, there is no recognition of a liability. But unfortunate problem is, there are certain companies like airline, flying services, which are basically operating on passenger airlines, where majority of the airlines were basically leased out, where the entire machinery or the flight, which we call it in colloquial terms, is basically that aircraft is a leased vehicle, and that leased vehicle is basically being on an operating lease. Therefore, if you remember, under ratio analysis, we had a very critical ratio called as return on fixed assets. Now that return on fixed assets, when I start taking out a return on fixed assets for Indigo Airlines or SpiceJet, it becomes very difficult because such kind of assets are never presented in the balance sheet at all. Now if you ask them, sir, Indigo and SpiceJet does not have an aircraft as a property, plant and equipment. Yes, they do not have, because they don't own anything. All those aircrafts are basically run on leases, and majority of them being operating leases. When it becomes an operating lease, the asset is not recognized, but the income from the asset is recognized. So what about your return on fixed assets? The entire logic of giving your ratios is basically going for a toss when the representation formats are not appropriate. That is the particular reason why this standard becomes applicable now. Now, why did I write 2019 or 2020? I'll come back to that logic when I'm talking about transitional requirements. I'm not going to talk about it right now. Now, this session, we will start with the scope of the standard, trying to talk about the exclusions from the scope of the standard, or what are certain leases which fall outside the scope of the standard. And from there on, we will start looking at what contains a lease. When do you say a contract is, or when there is a contract contain a lease? That is something that we have to look at. If we would have gone with Ind AS 17, we also had Appendix A, B, or C. there are three appendix which are attached to Ind AS 17 which are no longer applicable now, but these three appendix are now forming part of the scope of the standard itself. Within the standard itself, they have embedded or included all this appendix. Now, what is this appendix basically? Guys, obviously everything goes on an improvement mode. Okay, immediately when you implement a standard doesn't mean that the standard is 100% set. There might be certain things in the standard which can go missing. Sometimes certain paragraphs in the standard are not sufficient enough to explain what the standard is. Now sometimes there does happen something like this. One of the very important standard or very easy standard for you to remember was your accounting standard 16 or your Ind AS 23 when we talk about borrowing cost. When we discuss about borrowing cost, there's a very important term called as qualifying asset which comes in. When they start discussing about qualifying asset, there comes a word called a substantial period of time. What is substantial? Now, nowhere in the standard, either under AS 16 or under Ind AS 23, the standard ever described what is substantial period of time. So there came in an accounting standard interpretation, ASIs. ASI 1 came out and said that substantial period of time is a period for 12 months or more. Or I would say something like this, as not shorter than 12 months can be considered a substantial period of time. So these are additional explanations to the standard to make the standard more holistic. So appendix is also very similar to that, where it starts discussing about certain aspects which were not dealt in the standard, or will start explaining certain aspects of the standard which are not clearly presented in the standard. So very simple long language, but under IFRS or under IAS they call them as IFRICs. IFRICs is basically what they use. We call it by a word called as appendix. How we have changed IFRS to Ind AS, we have changed IFRICs to appendix. This is a common terminology or colloquial language that we keep using up and down. Now, should I remember appendix ABC? Not at all necessary. Because your Ind AS 17 is no longer there, then even your appendix ABC has also been eliminated from your, the scope of the standard. So what does the standard even talk about? First of all, does the standard even have anything to discuss about? Now, whenever I discuss about the standard, guys, you can keep sending us any comments. I'll keep replying. Can I view the stream afterwards? Dude, come on. Yeah, you can view the stream afterwards because even the recorded session will be posted. No issues regarding that. But try to make sure that you're going live because it will be more interactive. Now, as we go about now, let's start understanding a little bit of concepts regarding what is the scope of the standard. So when I go with the scope of the standard, first you need to understand what is a lease. What is a lease? Basically, there are two parties. One party whom I call it as a lessor, and the other party whom I call him as lessee. The lessor is the owner of the asset, and the owner of the asset normally transfers right to control use of the asset in return. The lessee compensates to the lessor by paying some consideration. And this consideration, which we commonly know as lease payments. You can call them as periodic lease payments because there are series of lease payments which are made over the period, over the term of the lease. So you can call them as periodic lease payments as well. Yeah. So predominantly, the standard will be a very, very simple standard to understand and discuss. Should take not more than 2.5 hours for us to completely round up the standard. Okay. So where it uses a logics of AS 19 I will try to go about in a little bit faster pace. Where new aspects are being dealt with, I will start going a little bit slow. Now, what does the standard basically include? The scope of the standard, it includes all leases. There is no exclusion for any particular lease except a few which are anyways covered under other standards. They are normally getting covered under other standards, so that is the reason why they normally get excluded from the scope of your Ind AS 116. Now, what are those exceptions? The first exception I'll talk about is lease of mineral ores, natural gas, mines, etc. There's a separate standard to deal with this, so I'm not going to involve into this now. Number two, lease of leases related to agriculture. Dealt under Ind AS 41 specifically, so we don't have to involve ourselves into this. Leases relating to service concession agreements. What are service concession agreements? They basically dealt under Ind AS 115. To explain in brief about service concession agreements, I can put it up very simple sense. You can take a toll road, JMR or someone else will lay a road, or L&T lays a road. They are entitled to collect toll charges from us for a particular period of time, 20 years, 30 years, 50 years of lease. Now, airports are basically under service concession agreements because whenever you take off from Hyderabad airport or land at Hyderabad airport, GMR collects 300 rupees as convenience charges. Now, that is basically nothing but a part of service concession agreement because the airport belongs to the airport authority, but since it is being constructed or the entire infrastructure is being taken up by a private party, the private party has a right to collect a particular amount or a prescribed amount which the government nominates. The government normally nominates a particular amount which they can entitled to collect. So such kind of contracts are coming under service concession agreements. They are dealt under Ind AS 115 in depth. So I'll leave it there. Leases relating to intangible assets. Like I can talk about motion pictures, patents, copyrights, etc. All these are your intangible asset, but remember, this is optional. Why is it optional? Because it is covered under another standard, that is Ind AS 38. So if you want to deal it as per Ind AS 38, you can very well deal with it under Ind AS 38. If you want to deal it under Ind AS 116, you can take it under Ind AS 116. These are completely rights which are optional at the option of the enterprise. Either you can choose to deal it under Ind AS 116 or you can choose to deal it under Ind AS 38. These are simple exclusions from the scope of the standard. Now, if anyone has a doubt, you can go ahead as far as this is concerned or leases. Now let's try to progress from here on if you do not have any doubts. As we have close to 80 people who are already streaming, which is really fantastic. Keep it going, guys. Try to keep your friends also notified that the stream has started. You people, they can log in at any point of time. If they have missed something, then you can help them. Or anyways, the recorded video will be available. So ask them to please make sure that they subscribe. Anyways, going forward to it. Now, there are certain exceptions as far as the recognition is concerned. So that means a certain leases need not be recognized at all. Now, why do you say that certain leases need not be recognized? Dude, as simple as that, they're not material enough. When they're not material enough, what is the point of recognizing such kind of leases? For example, let's say the lease period is less than 12 months, such a short period of time. Now, before the end of the financial year, you will only find that only a few months of lease is still unexpired. Now, for such kind of short-term leases, is it necessary for us to do an entire exercise of dealing with Ind AS 116 is the question. I'm sorry guys, I think this is popped in for some reason. Yeah. So, is it necessary for us to basically deal with the entire logic of Ind AS 116 for such short-term leases? The second thing which I can talk about is leases for items which are of low value, small value items. The item itself is so immaterial. I'm talking about a company of a big size having a turnover of almost close to Reliance, lakhs of crores. Man. Okay, Reliance numbers are always very, astonishing because they reported turnovers of 4 lakh crores. I know crores has 7 zeros, that much I have. I have a knowledge on 4 lakh crores. How many zeros is a very difficult logic to be. So 4.5 lakh crores of a company. Then if I talk about a lease of a car, which is basically used to transporting the employees to office, then it becomes a too small a number for me to report. Too small a number for me to apply Ind AS 116 on it. Because the car in its value itself is less than 5 lakhs. In its fair value, if it is less than 5 lakhs, now does it even make sense when I'm reporting numbers which are rounded up in crores? I have rounded up numbers in crores. Does it make even a practical logic if I start reporting such small leases? Very difficult. That is the reason why, keeping in mind the materiality concept, these kind of recognition exemptions are also provided. Exemption from recognition. So you don't have to recognize these items at all. Now, what are these items which need not be recognized at all? Like I told you, there are 2 items. Number 1 is short-term leases. And second one, leases for which the underlying asset is of low value. What is low value is also explained as far as the standard is concerned. Yes, you can apply materiality, that is what he said, but what is low value? When do I say that the items have a very low value? So I can say that underlying assets are of low value underlying assets are of low value if, now I'll bring up some terminology which you can relate to in your Ind AS 115. Terminology is very similar. I'll bring back to you what is the paragraph in Ind AS 115 where the terminology is so similar. Language used out here is the lessee, the person who has taken that asset on lease, can benefit from the use of underlying asset by itself or together with other assets which are readily available second point. The underlying asset is not highly dependent or interrelated. Observe the language which is used out here. Underlying assets are of low value if the lessee can take a benefit from the use of underlying asset on its own by itself. That means he need not depend on any other asset to take a benefit. He gets the benefit of using the asset by itself. For example, I am having an asset like a AC air conditioner which is taken on lease. An air conditioner taken on lease, once it is established or set up, installed, I can take the benefit of the asset by itself. I need not apply some other assets together with it to basically extract some benefit out of it. So that is when I say that the underlying asset is giving me a benefit on its own. I am not depending on any other asset to give me a benefit for itself. Or together with assets which are readily available. Now, what is this readily available? Readily available means nothing but an asset which either I already own or I can procure it from market. Now, for example, I have an AC, then someone will come up and say, sir, you can have an AC and the AC can give you a benefit only if you have electricity connection. Yes, absolutely correct. It is already which I have electricity connection, or even if I don't have, it doesn't take much of an effort to get electricity connection into my house. Therefore, in such situation, I will say that the asset can give a benefit by itself or it can give a benefit with other resources which are readily available with the enterprise. Clear? Now, what is the second point? The underlying asset is not highly dependent or interrelated. What does it mean? That means the dependence or interrelationship with other assets in the organization is very low. It is very similar or related to what the first point is. It is saying that when you can get a benefit by itself, that means it is not customizable with other assets. It is not highly related to or integrated with other assets. For example, let's say I have taken a lease of a small part of an equipment. Now that part of an equipment can only give me a benefit once it is installed on the part. If it is not installed on the part, then it is not possible for me to take a benefit. That means there is a high level of integration which is necessary for the component which is leased out and with other asset, that is the equipment which I already have. Therefore, in such situation, I will say I cannot consider such kind of leases as lease having a low value. Now, I told you that these 2 points are something that we have already seen. Now, where did we come across these points? These points we have come across under Ind AS 115. Under Ind AS 115, when we talk about, if someone has already got it, you can please type in the comments. What is your answer for it? Under Ind AS 115, I have given you one very clear this thing, I guess. Now you tell me, under Ind AS 115, where did we see this terminology? This terminology we have seen when we wanted to identify or define what are distinct goods and services. When we wanted to define what is a distinct good or a service, this is there under performance obligations. I'm also specifying the step under which we come across these words. Step 2 under Ind AS 115 is identifying performance obligations in a contract. Under performance obligations in a contract, performance obligation is a promise to deliver distinct goods and service, or a series of distinct goods and services which are substantially the same and have a same amount of benefit to the customer. So this is the same language which is used under Ind AS 115 under distinct goods, where he says that the customer can take a benefit of the good by itself or together with other goods which are readily available to him, and the good is not highly dependent or interrelated with other goods and services. Then in such cases you can call them as distinct goods and services and can be identified as a separate performance obligation. Yes, Yamuna gets it. Yamuna has answered it right. It is distinct goods and services. This word is what we were specifying about. Now, moving on from there, where we were talking about underlying assets having a low value and short-term leases. Now, when I said, if you remember, we started here where we were talking about exemptions from recognition and we were talking about short-term lease. What do you mean by short-term lease? Now, immediately when I use the word short-term, someone might have already got in your mind anything which is within 12 months will be called as, less than or equal to 12 months can be called as a short-term lease. As simple as that. This is not a very typical definition, I guess. Majority of the places wherever we use the word short-term, it predominantly means 12 months. So again, I'll put it across the same thing. It is 12 months from commencement of lease. Don't calculate it from the end of the financial year. It should be from the commencement of lease. Because someone might have taken an 18 months lease on 1st October. You go in to do the audit on 31st March and he'll say, sir, the lease period is less than 12 months. So this is a short-term lease, not possible. Because your 12 months is supposed to be calculated from the day on which the lease commences. So that is very, very important under understanding what is a short-term lease. Now, one more thing which I wanted to tell you is the first exemption, the first recognition exemption regarding short-term leases. Short-term lease exemption should be consistently applied. That means what? One lease which is short-term lease, I ignored it, that I'll take the selective relaxation or selective exemptions are not possible.